Today, we'll study cash flow analysis. I have to bring back accounting, the topic that agonized you earlier this semester. At the time, you didn't have any knowledge about accounting and you were struggling. Now, you have had accounting, at least half a semester worth of accounting. So you should be more familiar with it and you should feel more comfortable about it. So let me start with accounting analysis. I did not have chance to upload it. This is the only page that I changed. I am going to add a couple more pages to the class notes and I will upload the revised version this afternoon. But anyway, look at this income statement of two companies, two identical companies. The only difference between the left one and the right one is the left one is all equity financed. Its capital structure is 100% equity, common stock only, no debt. Okay. The second one is identical company, but this company is not half, partially debt financed. It is using debt of $5,000. Let's start with $5,000 debt case. This is more realistic case because most of the firms are levered. They use debt. The companies that use debt are called levered firm. And the company that does not use debt is called unlevered firm. Levered firm and unlevered firm. A levered firm is the one with debt, and unlevered firm is all equity firm. Okay? And both of the companies they are identical because they are identical, their net sales are the same, 16,667. And operating expenses, including cost of goods sold, general selling and administrative expenses, all the expenses that are needed to operate the company is 15,000. And that operating expenses include something called depreciation. Let us suppose that depreciation is equal to 500. Just assume it, okay? I did not have time to incorporate that into the slide. So let's assume that depreciation is 500. Now, look at levered firm's income statement. It's net sales 16,667, subtracting operating expenses of 15,000. That gives you net operating profit. It is called net operating profit. It is called net because it is net of depreciation. Okay? It is net of depreciation. And as you know, that depreciation does not involve any cash disbursement. You are not actually spending cash for depreciation. Depreciation is an expense. It is part of the expense that will be subtracted from the revenue to compute the profit. It is not involved with cash disbursement. There's no cash outlay. Okay? So this is called non-cash expense. Non-cash expense item. So net operating profit is 1667. And then interest expense, 6% of the debt principal. So let's assume. So $300 of interest expense is deducted from net operating profit. That gives net profit before taxes. That's net profit before taxes. And assuming the tax rate is equal to 40%, tax is 547. Subtract that from net profit before taxes, you have net profit after taxes, NPAT. So that's the profit that will be accrued or that will be given to the stockholders. This is the stockholders' claim. Stockholders have claim of 820. 820 of the company's profit is stockholders. It's stockholders' money, stockholders' profit. Bondholders get 300, assuming that this bond is rolled over every year. Okay. So only interest is paid to the bondholders. So 820 and 300. So total profit or total money that are claims of that are given to the claim holders are 1,120. Right? Look at this very carefully. Forget this for the time being. Okay, 1,120. So here's net operating profit of 1,667. These are distributed to bondholders, 300, right? And to shareholders, 820. And shareholders and bondholders are all the claim holders of the company, and claim holders of the company get 1,120. Okay, are you with me so far? This is an example, a hypothetical firm that uses debt in the capital structure, and total claim holders' total claim will be 1,120. Now, look at this all-equity firm's case. For the all-equity firm, up to net operating profit, it's the same. Now, interest expense is 0 because there is no debt. So net profit before tax will be 1,667, and taxes will be paid, 40% of that. So net profit after taxes will be 1,000. And all the $1,000 are to the stockholders. That's stockholders' money. Stockholders have the claim on the entire $1,000 profit. So stockholders get 1,000. Now, using the same computation, net operating profit of all equity firm is again 1,667, and that will be given to stockholders, and there are no bondholders, and stockholders get 16. Take that back. 1,000. So claim is 1,000. Claim the investors, bondholders and shareholders, the claim holders of the levered firm, their total claim is 1,120, and for the unlevered firm, the total is 1,000, and the difference is 120. Where does this 120 come from? Where does this 120 come from? Look at this carefully. Compare these two columns, and you will see the difference, where that difference comes from. It's because of tax. Tax. Going into debt, you can save tax. You can save tax by the amount of 120. Tax rate times interest payment is the amount that is being saved. By going into that, you can save tax. And this saving tax, or here, 120, is such an essential point that will come back and play an important role in determining capital structure of a firm. Okay? That discussion will be later in the semester, probably early June. We'll talk about how this tax saving due to interest payment will affect the company's capital structure. We'll discuss that in June. But for the time being, I want you to focus on all equity firm. Even if you are looking at this levered firm, look at the cash flows of all equity firm. That's what we are interested in. Okay. So I am going to write the income statement of a hypothetical firm using that as an example. Here's net operating profit before tax of 1667. And do not subtract anything. That's net operating profit. Subtract only the tax on this. And tax rate is 40%. So 667 will be deducted. And the next line is net operating profit after tax of 1,000. This is what we are interested in when in doing capital budgeting analysis or project analysis. The numerator, cash flows, will be discounted back, and the numerator are net operating profit after tax. Operating profit, okay? 1,000. This is the profit, not the cash flows. In order to find cash flows, we add depreciation. Add depreciation of 500. And the company will make investment. The company will have to invest in order to operate. So, investment. Let us assume that investment is 600. 600 is being invested. So, subtract 600. So add 500 and subtract 600. And the resulting one is called free cash flows. Free cash flows, and free cash flow will be 900. And free cash flow is what goes on to the numerator of your analysis. Project investment decision. When you analyze your project feasibility, you find free cash flow to the claim, free cash flow of the firm, and the computation of free cash flow is this way. Now, this is your project by Wednesday. By Wednesday, you are supposed to find net operating profit after tax, so-called NOPAT, NOPAT, and free cash flows for the past 3 years. Free cash flow to the firm. Okay. Kwang Yi's question was free cash flow to equity holders, free cash flows to the firm, and I am teaching you only free cash flow to the firm. Okay. But this one comes from the company that is with debt. In practice, you look at the income statement of a levered firm, your company. What's your company? Eh? 대웅제약. 대웅제약 is levered. It uses debt, right? 대웅제약 has interest expense, okay? You have to find the financial income statement of 대웅제약 without interest expense, assuming that the company is 100% equity financed. So this is the actual case, and you are supposed to find this case. You know what I'm saying? This is what you observe in the financial statements. And you are supposed to find all equity firms' income statement to find net operating profit after tax and free cash flows. So for that, you need to find tax rate. By looking at the historical income statement, you can find average tax rate. So use that average tax rate to find the appropriate tax rate and find net operating profit after tax and free cash flows. They will be used later for the purpose of valuing the company, valuation of the entire company. And toward the very end of the semester, you will hand in the valuation analysis of the firm, and there you will be using the numbers. So net operating profit after tax and free cash flows for the past 3 years and projection of the next 2 years. Okay? Doesn't have to be precise the prediction or forecast. Just try it. Just do this exercise for your own benefit, okay? That way you can feel more comfortable about company's financial analysis. Right. Any questions? So this project is due this Wednesday. You're supposed to hand in by midnight this Wednesday. Yes. It should. Bring it over to me and I will explain to you where to find depreciation. All right. Today's lecture, with about 25 minutes left, I'm going to talk about project cash flows, first look, incremental cash flows, pro forma financial statements, and project cash flows. And the rest of it, the rest of the class notes will be discussed on Wednesday. Here is the present value formula. NPV is equal to sum t starting from 1 through t and cash flows at time t divided by 1 plus r to the tth power minus I sub o. Today and Wednesday, what we are concerned about is this cash flow thing. How do we define the cash flow? How do we define the cash flow? What kind of things to be included in the cash flow? Okay? That's our discussion. Okay? Let's read what's written, what's shown on the slide. The cash flows that should be included in a capital budgeting analysis are those that will occur or not occur if the project is accepted. This is a very important one. I think if I were you, I would use a different color pen, such as red pen, to underline this about 10 times. Because this will be on your test, final exam. Okay, I told you. I told you. Okay, the cash flows that should be included in the capital budgeting analysis are those that will occur or not occur if the project is accepted. So if there is a cash flow that occurs regardless of the acceptance of the project, if there is a cash flow that is to occur regardless of the project in hand, that cash flow should not be included in your analysis. Only if the cash flow that is affected by the acceptance of the project should be included in the project. I use the term cash flow that is due to the acceptance of the project. I call that due to principle. Cash flow that occurs due to the acceptance of the project is to be included in project analysis. Okay? So you include all the cash flows that are to occur or that that would cease to occur because of the project. Those cash flows should be included. And examples will follow on Wednesday, but let me emphasize this again and again. Cash flows that are to occur or not occur if the project accepted will be included in the analysis of the project. Those cash flows that are influenced by the acceptance of the project are called incremental cash flows. Incremental cash flows. So I use the expression sometimes, change, that delta means change of free cash flows at time t due to the acceptance of the project. Free cash flows, change in free cash flows that are the result of the acceptance of the project will be included as the numerator of this equation. So when we talk about cash flows of a project, that means change in capital, free cash flow, or incremental free cash flows. Incremental free cash flows due to the acceptance of the project. The standalone principle allows us to analyze each project in isolation from the firm simply by focusing on incremental cash flows. 한국말 요약. 프로젝트를 채택했을 때 프로젝트를 채택했기 때문에 일어나는 캐시플로우는 프로젝트 애널리시스에 다 포함해야 된다는 얘기입니다. 지금 회사가 현재 프로젝트와 관계없이 회사가 진행되고 회사의 캐시플로우가 있는데 프로젝트가 채택되면 만약 그 발생하는 캐시플로우가 줄어든다면 그 줄어드는 캐시플로우도 역시 이 프로젝트에 포함이 돼야 된다는 얘기예요. 프로젝트 때문에 줄어들기 때문에. 그러니까 프로젝트 때문에 늘어나거나 줄어드는 캐시플로우는 다 프로젝트 애널리시스에 포함해야 한다. 그런 얘기입니다. 이해가 됩니까? 그거를 incremental approach라고 그래요. incremental. 증분 원칙이라고 그래요. 증분 원칙. incremental due to the acceptance of the project. 프로젝트 때문에 증가되거나 변화하는 캐시플로우는 다 우리 분석 대상 캐시플로우에 들어간다는 거예요. 오겠죠? 오케이, 되죠? 이해가 돼요? 오케이, move on. Asking the right question. You should always ask yourself, will this cash flow occur only if we accept the project? If the answer is yes, it should be included in the analysis because it is incremental. If the answer is no, it should not be included in the analysis because it will occur anyway. If the answer is part of it, then we should include the part that occurs because of the project. And I will give you examples on Wednesday, so wait until Wednesday. Sometimes there are cash flows that could occur without the project, but would not occur if the project is accepted. These cash flows will need to be included, but with opposite signs. For example, in a replacement decision. That will become clearer when we discuss the actual case. Okay? Again, you should always ask yourself, will this cash flow occur only if we accept the project? Will this occur because of the project? Then include it in your analysis as part of the cash flows. Okay? If this cash flow occurs regardless of the project, anyway it's going to occur, then you should not include it because that is not due to the project. Okay. Okay. These are the interesting discussions to have. Here's a simple example. Here's a pharmaceutical company. The company has been doing research and development to develop a new medicine for stomach cancer. Okay? Anti-cancer drug. And it takes a long time to develop a new medicine. I have a good friend who is still working as the senior researcher in a research institute, the Medicinal Research Institute in the United States. He has been involved with anti-breast cancer drug for the past 30 years. For the past 30 years, he has been working hard to come up with anti-breast cancer drug. 30 years. He spent millions of dollars to develop this drug. I don't know whether it's going to succeed or not, but he is still trying. Let us suppose that we are standing right here now, okay? T equals 0. And let's assume the past 5 years, the company spent $50 million to develop this drug. That's too big. Let's say $5 million to develop this drug. Finally, it has succeeded in coming up with a commercially marketable drug, okay, medicine. And in order to produce, it requires a new plant and new equipment, a new machine, and so on. So initial investment is $5 million. And if this product is successful in the market for some T years, present value, T starting from 1 through, say, T years of change in free cash flows because of this project, discounted by appropriate discount rate R. Let's suppose that this is equal to, just assume that this is equal to $8 million. Let me recap. Okay, the company has spent $5 million for R&D and test marketing and product development. total cost was $5 million. The company has already spent $5 million, and the company is about to invest $5 million in order to have cash flows. Present value of those cash flows equal $8 million. So find the net present value. Multiple choice. A, 3 million. B, 2 million. C, minus 2 million. D, minus 5 million. Okay, what is your answer? You know the problem. You know the problem. Present value of all the future cash flows is 8 million, and investment is 5 million. The company spent 5 million for development. So what is the net present value? Is that 3, 2, minus 2, minus 5? If you abstain, I'm going to knock off 10 points from your final exam, okay? How many of you think that it is A? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. How many of you think it is 2 million? 1, 2. Don't look at the people. It's 2. How many of you think it is minus 2 million? 1, 2, 3, 4, 5, 6, 7. How many of you minus 5 million? 2. Okay, 2 plus 2 is 4, plus 7, 11, plus 10, it's 21. How many students are here? Well, there are some people who are absent. About 50 students are in here. Where are the rest? 30 people. Okay. Using this incremental principle, okay, look at this. Cash flows that are due to the acceptance of the project. This one is clearly included, right? Future cash flows that occur because of the acceptance of the project. That should be included, right? So NPV 5, 8 million. That's the present value of all the cash flows that occur because of the project, minus initial capital outlay of 5 million. That ought to be included, right? The question is, should we subtract this 5 million or not? The question is, should we subtract this 5 million? This 5 million is because of the project. It is certainly because of the project. But it is not because of the acceptance of the project. Is it? It has already occurred. Whether you accept the project or not, that cash flow will not change. You have already spent 5 million. Right? You have already spent 5 million. So this has occurred. This will not occur in the future. This has already occurred. It will not change. Whether you accept the project or reject the project, it wouldn't change. So should you include or should you exclude? Okay, so you don't subtract 5. Okay, you don't subtract it. And there's nothing else. So the answer is 3 million. Right? Do you get it? And this kind of cash flow that has already occurred and will not change because of the acceptance of the project is called sunk cost. Sunk cost has already occurred, has already sunk. You cannot recover that. Okay? Sunk cost is gone. Sunk cost is gone. Don't cry over spilt milk. It's already spilt. It's already spent. Never mind, never mind. That has already occurred. So the first principle, number one, forget sunk cost. Forget sunk cost. Forget sunk cost. Get it? Opportunity costs. Opportunity costs. You know what opportunity costs are, right? Let me talk about the sunk cost case a little more. A good example of the sunk cost is a U.S. company called Lockheed. Lockheed is an aircraft manufacturer. Wide-body jet like Boeing 747, McDonnell Douglas DC-10. These are wide-body jets. When McDonnell Douglas and Boeing introduced wide-body jumbo jets, Lockheed also introduced a wide-body jet. I think it's called L-1011. And it was a nice aircraft, but it wasn't good enough to generate positive revenue. So first couple of years, it was incurring losses. Okay? It was not doing well. And right at that moment, the planning people, the controller's office and treasurer's office, CFO, came to see the CEO and say, we should not continue with this project because in the future there is no hope. From now on, the project doesn't seem to generate positive cash flows. It will be, the more we keep it, the more we will lose. So it's best for us to stop operating and let's get out of it. Let's exit from the project. The CEO answered in the following way. Think about how much money I have spent on the project. I've spent billions of dollars for this project. And are you asking me to forget about the $1 billion that I invested? And the CEO gently said, if you don't want this way, you leave. My way or highway, that's a good expression. If you don't want to follow my way, then you take the highway to go home. So this CFO, he in fact took the highway and went home, and he didn't stay home too long. He was recruited by Airbus, and some have been recruited by McDonnell Douglas. Some were recruited by Boeing. And these Boeing, McDonnell Douglas, and Airbus, they created their own improved versions of wide-body jet, including, I think, A3, Airbus A380, A380. A couple of years later, Lockheed finally realized that it made a mistake. It shouldn't have continued. So it stopped. But before it stopped, and before it lost tons of money, the CEO went to see Japanese Prime Minister. And Japanese Prime Minister's name was Tanaka. He went to see Tanaka and asked Mr. Tanaka to have Japan Airlines and Japanese Airlines to buy these aircrafts from Lockheed. And in return, this CEO gave a bribe to be used as political fund, slush fund, 비자금, 정치자금. That bribery scandal was finally caught. And Mr. Tanaka, Prime Minister Tanaka, was the first and perhaps the last current Prime Minister who was arrested from his own office and sent to jail. And it's because of the CEO's the thought of losing already sunk cost. He should have forgot the initial investment for the project because the project is not feasible. Once you think that it is not feasible, give up. You do not stick to what you have already spent. Sunk cost is forever sunk, forever gone. So forget sunk cost. In the United States, because after this incidents, U.S. legislature, U.S. Congress has passed a law called Foreign Corrupt Prevention Act, Foreign Corrupt Practice Prevention Act, or something like that. If you are caught for giving bribe to foreign national leaders, you will be penalized much strictly, very strictly. And after that, U.S. government officials, they don't even take presents. That might be considered as bribery. So this is a famous incident about sunk cost. Forget sunk cost. Are you with me? Forget sunk cost. That's a very important first principle that you have to learn in applying this cash flow analysis and capital budgeting. Okay, that's all for today, and I will see you on Wednesday. Wednesday we'll do the rest of these, and we'll also do some practical problems. Okay, that's all for today.